There's a look at the U.S. big banks, the money center banks. We do start getting earnings report from that group tomorrow. Let's bring in Sheraz Mian, Director of Research at Zacks. Sheraz, thanks very much indeed for joining us. What are you looking out for in this reporting season, please?
Thanks for having me. It's supposed to give us a relatively clearer view of the overall operating environment for the banks and for the broader economy as a whole. For the finance sector as a whole, about 11% earnings growth is expected. For the big banks, it's much less than that. But the indications are that perhaps the surprises will be to the upside, as many of their constituent businesses appear to have done a lot better in Q4 than the analysts had penciled it in.
So did you say that the overall financial sector should show earnings growth of 11%, but the big lenders will lag that?
That's right. Yeah. So the expectation is for about half of that. For the big banks, but my own sense is that given the revisions trend we saw in terms of how the analysts were projecting estimates, I believe there's upside to estimates for these big banks.
The interest rates are not going to come down as quickly as people had hoped, it seems. Is that bad news for these big U.S. lenders?
So near term it is, but we should keep in mind that these banks operated over the last couple of years with an inverted yield curve. So the fact that we now have a steeper yield curve, meaning the gap between the short and the longer end of the Treasury yield curve is positive now, is a net positive for these companies. And in fact, the favorable revisions trend I was referring to is a function of this interest rate backdrop. So yes, on some consumer and other ends, a higher, longer yield is a net negative and reflective of some issues that in key parts of the economy will continue with us. But on the whole, to the extent that these higher yields are reflective of a better growth environment for 2025 and beyond, that's positive for banks on the whole.
Maybe we can put up a five-year chart for JP Morgan. People have doubled their money in that stock over the past 5 years, roughly. Or Wells Fargo, it's been a laggard, 64%. What are the crucial things people want to see from bank CEOs these days?
So banks, you have to keep in mind, are very cyclical businesses and also very heavily regulated, particularly the post-2008 financial crisis. A host of new regulatory strictures were imposed on the businesses, which in the minds of some investors have reduced the long-term earnings power of these businesses. So one of the relatively optimistic view for financials as a whole in the marketplace at present is that the incoming Trump administration and their relatively more permissive regulatory regime will be good for them. Less capital requirements, perhaps allowing these companies to return some of that cash through to buybacks and dividends. But on the whole, as economically sensitive businesses, the commentary from these management teams about what they see as emerging trends in the economy, in my judgment, will be key for all of us. JP Morgan, Wells Fargo, they touch consumers and businesses at different levels in the economy, and what they see has resonance for the market as a whole. So their macroeconomic take and what they see as emerging in 2025 will be the key takeaways.
Sheraz.